I have the pleasure of knowing Matt on a personal level, and I'm really excited to be able to talk with Matt today about everything from his background as a regulator, as an investor, and his experiences, as well as his experience dealing with the current regulatory environment in the United States, as well as internationally for digital assets, and understanding how that impacts his view as an investor looking at early stage digital asset investments. So Matt, thanks so much for joining me here today. Love it if you could give a little brief background on who you are and how you got to where you are today.
Yeah, well, thanks, Justin, for the opportunity to be here. It's really a pleasure. And yeah, I think most people who become regulators don't plan to become a regulator, right? It's sort of something you fall into. And I had always wanted to be a diplomat, and through sort of some unfortunate timing, came out of graduate school during the great financial crisis and saw financial regulation as an area where I could have a much greater and more immediate impact. And so since then, my career is really focused on emerging technology and financial regulation in that intersection. So I've been a regulator twice, FDIC earlier in my career, then more recently at the New York State Department of Financial Services, where I oversaw the division that was responsible for digital assets. I've worked in-house in fintech firms too, first at a company called Quovo, which was acquired by Plaid, where I then worked as well, and have spent some time in emerging markets too. And now for the last 2 years, have found that sort of eclectic set of experiences has positioned me well to have a unique perspective as a venture capitalist.
Great. And so when you say emerging technology, I think of both blockchain digital assets and artificial intelligence. And so maybe we can tackle the AI as well, if that's something you've spent any time on. How do you think about when you say emerging technology? What does that mean?
Yeah, no, it's a good question. I mean, I remember, so when I'll tell you a little story, just kind of illustrate it. I mean, when I was earlier in my career, I was in the area that was focused on depositor consumer protection. And I sort of took it upon myself to be kind of the guy that would test new products that came out. And this is when it's not like today where if you couldn't sign up for every new fintech product, right? I mean, there's just no way you could do that. But back then there weren't quite as many. And the technology that got a lot of people excited within the FDIC at the time was remote deposit capture. And I don't know if you remember that, but which is just the ability to open a mobile app and take a photo of a check, and then that check is deposited into your account. And at the time, that was sort of revolutionary, right? So for me, emerging technology, that was sort of that doesn't seem as emergent anymore, and it's not. But for me, emerging technology is really just anything that significantly challenges the status quo. And I think that AI and blockchain related financial services are for sure kind of the two areas today that pose the greatest chance of dramatically altering the status quo.
That's definitely the precipice on which we all sit today. So you've had experience as both a state regulator at the New York Department of Financial Services and as a federal regulator looking at consumer protection at the FDIC. So how do you think about state versus federal, if that's the right way to position the two today, with respect to, let's focus on blockchain technology and digital assets, because there's certainly been some states that are leading the way and a lot of industry demanding a more comprehensive federal approach to create kind of a clear playing field, which doesn't seem like we're on yet.
Yeah. Yeah, I think that the federal state dynamic is a really important one to understand. And it's one that is, I think, somewhat unique to the American context. I mean, it does exist in some other places. I mean, Canada has somewhat similar system, but I think it's still pretty unique. In some ways, I think Europe may even be starting to mimic more of a U.S. approach, right, with kind of EU level regulation and then subnational implementation of regulation. But so this is sometimes referred to as a dual regulatory system or dual banking system within the context of banking. And you kind of either love it or you hate it. And I think whether you love it or hate it depends on where you sit, right? And what industry you work in and I think whether your industry is a nascent industry or an established industry. So my sort of personal view, and I'll talk about what it is, but I'll talk about what kind of dual regulation means, but is that dual regulation is particularly beneficial for nascent and emerging areas. And then as industries become more commoditized, so to speak, or more standardized, that's when national approaches become more favorable. But so let's talk a little bit about kind of the difference between state regulators and federal regulators. So federal regulators have national coverage, so they can cover the entire United States. They're typically very well resourced, often independently resourced, and not even reliant on appropriations from Congress. But they tend to have a very narrow mandate, right? So they can only do what Congress has specifically instructed them to do. And they tend to be fairly slow moving by design. In contrast, state regulators, subnational coverage, although for states like New York or California, the influence is often beyond your state's boundaries, less well-resourced, sometimes significantly less well-resourced, but you have often a much broader mandate within the boundaries of your jurisdiction. I think in the state of New York, the Department of Financial Services has dozens and dozens of different categories of licenses for financial services, for non-bank financial services, for insurance, for just a whole host of things that are not regulated at all at the federal level and fall in the states. And then the other kind of, I think, distinction at the state level is that when they want to, they can move quite quickly. And I certainly saw, that sort of can be seen through a number of different examples, including the creation of the BIT license, which is contentious at the time, still contentious to some, although I think it has shown its value in sort of in the test of time. But so that's really kind of the dual banking system. And the reason I mentioned at the beginning that I think it's particularly relevant for nascent areas like digital assets is because it allows emergent new areas of technology to emerge and to be regulated and to allow regulators to sort of discover, right, the best way of regulating that. And another sort of colloquialism, so to speak, is that states are the laboratories of democracy. And that is certainly true around financial regulation. So I'm of the view that the dual banking system is very important and important to keep because it is sort of an enabler of innovation while at the same time protecting consumers by providing, to some degree, some redundancy, right? Because you've got many different sort of cooks in the kitchen, so to speak.
Yeah, absolutely. Laboratories of experimentation is exactly where I was thinking as you were talking about it. And I don't know whether I should be happy that the notions of federalism may be migrating over to the EU, given their structure, or not. I'm not sure if we're getting it right or wrong, but I also am a fan of the dual banking system, as you and I have previously discussed. You mentioned the BIT license, which of course is a New York license, and you have experienced the New York Department of Financial Services. Maybe could you share something that one of those you had to be there kind of moments, right? Like you were at the cutting edge of regulation in a state that was leaning into emerging technology-led regulation, came out with one of the first, if not the first, specialized licenses for digital assets. And I'm sure there were some challenges and unforeseen circumstances. And I would love to hear at least one of those stories.
Yeah, I may have a few I could share. You can cut me off when you decide to, but yeah, I wasn't there. I wasn't there when it was created. I came after it had been created. And so my job was a little bit different, which was to sort of figure out how to scale it and make it more accessible. And I think one of the things that I was particularly keen to try and solve is making it more accessible for earlier stage innovators. And I think, to be clear, there's still a long way to go there. But that was something I felt particularly strong about. And my approach when I got started was just to listen to people. And I probably spent half of my time, the first few months of the job, just letting people sort of vent. And it was actually quite effective in terms of clearing the air and also getting new ideas. And so I think that one of the big learnings I had is that when you're regulating a new and emerging area, you have to be in constant dialogue with with industry. And I'll give you kind of one specific example, and I think it also illustrates what made me sort of see promise in blockchain as sort of I would say I was probably a little more skeptical of the space pre-regulator, and being a regulator actually helped me kind of see the potential a bit. maybe sort of unusual, but if you kind of remember the COVID years, the beginning of COVID,
they're hard to remember.
Hard to remember, right? But I think that a number of regulators, including us at DFS, were very quickly trying to assess, well, what is the impact of this on the banking sector and and just financial services? And you kind of had to really kind of connect the dots and think through it. And we started thinking of all sorts of areas. Okay, what about a small business that's paying rent to the owner of a building, and then that they no longer have customers, and so they're no longer pay rent, and then that is there an impact on kind of the commercial real estate market and kind of mortgage lending there? And we realized that we needed data, right? As real-time data as we could get. And we sort of discovered, although we already knew it, that most data regulators has a significant time lag, right? And I mean, even for banks, it's not great, right? I mean, there's sort of, it's quarterly, but then there's a lag on the quarterly data. And then for non-banks, it can be sometimes it's even only annually, right? So that type of data is not useful when you're trying to figure out how are you doing right now. And so we put together kind of just surveys, and you can think of them as sort of Google form type surveys, and really just kind of clanky stuff. But I sort of had this thought that blockchain is sort of interesting from a regulatory perspective because the data is public. And could there be a way to regulate blockchain that is better than kind of prior forms of regulation, right? Or regulate maybe the wrong word, but is there a way to kind of take advantage of some of the inherent features of it? And so one of the things we did, we hosted a tech sprint, and we brought together folks from across the industry, from companies, from academia, from other sorts of vendors and firms in the space, to focus on that problem and think through, are there better ways of conducting supervision in this space that are more effective for regulators and easier for industry actors? And it turns out that there were. And I think that type of collaboration is really important. And unfortunately, I think we haven't seen as much of it recently.
Yeah, the collaboration between industry and regulators is really important. And sometimes it's right. They get it right, and sometimes they don't. Interesting to hear how that played out during COVID. You're talking a little bit there about how kind of innovative technology then has an impact on regulation. Let's talk about it the opposite way, and just how does regulation or legislation have an impact on innovative technologies? So earlier you mentioned remote deposit capture, which my naive or perhaps uninformed view stems a little bit from a legislation, right? So there's an act, a Check 21 Act, that enables then this type of truncated copy of a check to be useful, and then technology comes out and takes advantage of that. But there's a lot of people arguing that the lack of legislation, particularly in the digital asset space, is stifling innovation. Do you agree that it stifles innovation, or do you think that is misplaced?
Yeah, I think it probably is. I mean, I think the challenge, whether it's legislation or regulation, is that it is sort of timing and how far do you go, right? Because to some extent, the job of a regulator, and I'd argue even sort of on the legislative side, is to do your job effectively. You want to see kind of how the market is shaping up, right? And you want to see what it's looking like, so that you can write sensible rules. If you're sort of too early, right, you may write rules that are just totally irrelevant, or just totally kind of destroy an industry before it is allowed to exist. I think so I mentioned that because I think where we're at now is the point where we do need something. And I think that's been very clear through sort of many different examples. And we talked a little bit about the dual banking system, but of course there's also this concept of federal preemption, which we haven't talked about. And that is that the U.S. Congress can preempt state law where they pass laws to do so, and where it's sort of permissible kind of within the framework of the Constitution. And so in the security space, that's one example, right, where we're seeing a regulator that's very robustly and actively working to set the national standard, but doing so outside of a legislative context.
Regulation by enforcement, I think, is what we're talking about there from the SEC. So we're at this moment, particularly with digital assets, where we are perhaps in need of legislation, perhaps federal legislation, to create a clear framework across the country. And in May of this year, you testified before a subcommittee on the House Financial Services Subcommittee, focused on digital assets, financial technology, and inclusion. And you were talking there about stablecoins and potential stablecoin legislation. Can you tell us a little bit about what your position is on stablecoins and where you think any legislation will ultimately land, and when it will land? Will we actually get legislation on some of these topics?
Yeah, see it soon. I mean, stablecoins are such a no-brainer in my view. I mean, it's sort of like, in my perspective, you'll hear some people talk about stablecoins as like it is just totally revolutionary. It's and it's just a dramatic sort of improvement. And while I do sort of think that's true, I also think in some ways it's not. It's actually quite iterative, and it's just sort of a small incremental improvement on existing movement of money. And I think that's particularly the case from a regulatory perspective. So from a consumer and market and industry perspective, it can be quite transformative. But from a regulatory perspective, it's actually not that different from what regulators are used to. And so you put those two together, and it has the ingredients to be just a huge win for everyone. But so regulation, so stablecoins, you can think of them as I mentioned, sort of almost like money transmission. So if you think about the big players in the money transmission space, and I know it's a space well, you've got players like PayPal and Block, and they have money transmitter licenses in many different states, and they hold money on behalf of consumers. Consumers often do hold some type of balance, right, in those accounts, but they're intended mostly for payments. And so the legislation that's been contemplated here is around payment stablecoins. This is important, like, so to highlight, and stablecoins that are fiat backed. So very specific type of kind of the stablecoin, kind of the safest type of stablecoin. New York has had a regulatory framework for stablecoins for quite some time, and it's a framework that federal legislation has been modeled after. Chair McHenry has mentioned that publicly a lot recently. And really there's sort of three key pillars. One is focused on reserve requirements, and that's requiring that any dollars that are held, that first, the stable coins must be reserved on a one-to-one basis. So for every dollar that you have issued in a stable coin, you must hold at least $1 worth of cash instruments. And those cash instruments can be cash, they can be government securities, and things sort of that nature. The second big requirement is around redemption rights, right? The consumers or holders of these tokens must have a clear right to redemption on a one-to-one basis. And there are sort of other things associated with that, such as like clarifying the timeline for redemption. And then the third kind of big prong that you see in Park, and you see reflected in the federal proposal, the proposal from Congress that passed the subcommittee recently, is related to transparency. And that is audits from independent third parties to verify the assets that you're holding. So it's really not that complicated. And I actually think there's bipartisan recognition of that. Like the underlying rules, I actually think there's like agreement on like what the rules should be. The debate,
bipartisan agreement? That will be special to see.
Yeah. I think where there's disagreement is around like who can regulate this space. And this comes back to sort of the dual banking system and dual regulatory system we talked about, which is that There are some that believe that the states should continue to have a role and we should preserve that system. And then there's some that believe that the federal government should preempt the states within this system. So that I think with enough time though, something will pass. I think if we were betting on it, I would not bet that it will pass this Congress. But I think that's sort of typical, right? I mean, it'll be sort of introduced a few times and then eventually it'll sort of pass. I do think it will pass. I think it's important to know that there's nothing stopping today stablecoin issuers from emerging at the state level using trust company type charters to issue stablecoins. There's some questions around, I mean, the SEC, may have some views and there's some issues working through kind of the court system around that and when and where they may view a stablecoin as a security. But like it's my view that to some extent we do have clarity and you can issue stablecoins today at a state level. The other thing that is sort of, I think, important to understand about this space is that there's nothing stopping foreign issuers from issuing US dollar-backed stablecoins. In fact, today, the majority of US dollar-backed stablecoins in circulation are issued offshore. And you put all those things together, and there's a lot of, I think, incentive for Congress to act. I mean, we should be able to, if these are US dollar-backed stablecoins, I mean, we should be able to regulate them as within America and by American regulators. And I think that is sort of well understood.
Yeah, that's interesting. And we could get into the weeds on whether a trust company is a bank for purposes of securities law, which actually raises very, very interesting questions. Yeah. We'll put that one aside for now. I'll actually go a little bit further on that international basis. We talked about the fact that the majority of actually US-backed stablecoins are issued by foreign entities, and then that there is like a different regulatory environment in other countries. I wanted to also bring up that a digital currency backed by a government has come out, right? Like there is a digital yuan among other kind of like national stable coins. What's your take on how the market will evolve in the absence of legislation? And like, what are you seeing internationally that's piqued your interest?
Yeah, I mean, the international dimension is really interesting because I think on one hand, U.S. regulators don't care about that space at all, right? I think that it's interesting. Sometimes you'll talk with companies or investors. They'll say, we just got to go in and tell the regulators that if we don't do this, China is going to do it. And regulators don't really care because that's not part of their mandate. Congress may care, right? Because Congress has an interest in ensuring the competitiveness of the United States. But unlike regulators in other jurisdictions, most U.S. regulators do not have a competitiveness mandate. And I think that's actually something I sort of recommended in my testimony in Congress, is that I think that's actually very important. And I think that's one sort of structural change that could change a lot, actually.
Important to add.
Yeah. Add that as a part of the mandate. States often do have this type of a mandate, interestingly, and that's why you see sort of this competitiveness between states where they have a mandate for economic development, for job creation. And so states often take a more holistic view when they're regulating and they're balancing a broader set of actors, whereas federal regulators, the focus is typically on safety and soundness and stability and making sure nothing bad happens. I would say that I would sort of summarize it as that, like the focus on making sure nothing bad happens. It's not on making sure good things happen, right? To be clear, like they're not focused on making sure good things happen. It's preventing bad things from happening. But the international space is interesting. I sort of believe that there's sort of this 18 to 36 month window where for other jurisdictions to lay credible claim as being hubs for the digital asset space with robust regulatory frameworks. And so you sort of see this race underway now. You've got the EU that passed RICA, and now they're going through sort of a consultative process, which is kind of remarkable, right? I mean, it's a sort of an American concept in some ways, but it's not something that regulators have done recently, like engage in public consultation on these topics. They're going through that process, and they'll be implemented at the state level. You've got the UAE, and a lot happening in the UAE, including in Dubai, which set up the first sort of dedicated regulator just for digital assets called ERA. And then you've got Hong Kong and Singapore, right? Very, very active. And others as well. But I think that is, and the approach is just very, anyway, it's just a different, you spend some time in some of these countries talking with people, and it's like you're on a different planet. I mean, I got back from France, met with French and European regulators there, met with local founders, local investors, and it is just such a different approach. Like I mean, their regulators in these markets are taking a very pragmatic approach to regulating the space. So that I think
drives that. What do you think leads to their current more pragmatic approach around this technology?
I think a few things. I think one is that they're probably just doing things the way they've always done things. I think the fact, like I kind of had this moment talking with the regulator there where we're kind of just like laughing about this. Like, I don't know that they've really done anything differently. I think it's just the contrast with the U.S. is so stark now. I would describe the U.S. response as quite emotional. And I think the reason it's been so emotional in part is because, right, there was this sort of sheep in wolves clothing in the form of Sam Bankman-Fried that had built, like, kind of became part of the family and like had built trusted relationships throughout DC, and then
bought relationships, perhaps.
Bought relationships. However you may want to describe it. I mean, he had sort of gained the trust of people through various mechanisms, and then sort of revealed himself to not be the person that people had thought he was. And so, very understandably, I think that's provoked a really sort of emotional response. I think in other jurisdictions too, though, there is sort of this competitiveness focus, and people, and you see this in sort of headlines and things of that nature throughout the world, that countries really are trying to take advantage of this sort of moment to become a player in the space going forward.
So you mentioned there's this, let's call it 18 to 36 month window, which is your kind of time frame. Where are we in that window? If we say that let's say we have 36 months, entities like the United States regulatory environment have 36 months before the world is so far ahead, or perhaps some other jurisdiction has established such a leadership position that the markets have moved there. Where are we in that 36 months?
Yeah. Well, I said 36 months because I think the U.S. will eventually get it right, actually. I think that's sort of like, I think that we have a tradition of sort of driving up to the cliff's edge, and then we sort of like figure things out and pump on the brakes. And so I think we will kind of figure things out, probably sort of, I mean, it's just sort of a guess that's within that time frame. And so that's really kind of the window of opportunity, I think, for other jurisdictions to make progress.
So you mentioned we drive to the cliff's edge. We certainly do that in many different kind of dimensions for U.S. policy, and perhaps we're doing that today with digital assets. It seems like we are, and one could describe that a bit as a pendulum. And so, where do you think we are on this pendulum of kind of like regulation by enforcement or lack of legislation? And how would you think of that as a mental model?
Yeah. So, and I think that, I mean, just kind of also thinking about the perspective of investors in this space, right? I mean, when you're investing, you have to think about the market context, right? And kind of when you enter the market, or at least ideally, like you want to be able to take advantage of that. And I think right now is really kind of that ideal moment for a variety of reasons. And I'll get back to the point, but just that what I'm saying is just, it's just significantly than it was 18 months ago. Fewer founders in the space, but incredibly high quality founders, repeat founders. Valuations, of course, are much more attractive today than they were previously. A much more significant focus on real world use cases. I mean, one of the major themes in Paris at ECC, the conference, was a tokenization of real world assets. So you sort of, I think, and then you see like the continued institutional interest. I mean, right, the flurry of ETF applications. And I think anyway, it's just this kind of incredible moment of rebirth. And it's, from my perspective as a venture investor, sort of like the ideal moment, right, to get in. But when we think about kind of that pendulum more broadly swinging, I mean, I think we may be at a point where it's swung to its maximum outermost apex. I don't think it's going to swing back like super quickly. I think it may just sort of like it may just sort of pause there, right? As if there were sort of a magnet, sort of, right? Sort of a magnet that's just like holding it there for a little while. And the reason I think we may be there is a few reasons. So we've got the court cases we talked about. The SEC is now on its heels. Even if I think these court cases are probably going to be scattershot. I mean, there's going to be some wins, there's going to be some losses. It's not going to be sort of the clear path to victory that many hope, but I think it definitely changes the narrative, right? I think the Ripple decision has already changed the narrative, and it's shown that the argument that things that are fine with current regulation just doesn't work. The other thing that's significant is that companies are no longer going to be afraid to fight back, right? I mean, you always tried to settle with your regulator, right? I mean, always. Now, I think that's no longer the case with regard to the SEC, and that because it's sort of a more existential fight, right? If you get someone's back up against the wall, they're going to have to fight. And I think that, that's one kind of factor that I think suggests that maybe we're at the apex. Another is, again, we talked about other countries getting really active in the space, and that does sort of exert pressure, even if it takes a while for the U.S. to feel that. And then you can combine that with kind of the incumbents we talked about continuing to be in the space and kind of this focus on kind of real use cases. I think that's where and then, there's the election cycle. I won't make any predictions on that just because, like, who knows? It's going to be, I think, like a really wild year next year. But yeah, I think that's what gives me optimism now is I think we probably, I think that some high degree of likelihood that we've reached that outermost apex.
Yeah, predictions on the election have proven far too often to be inaccurate. So we'll leave those away, but we will recognize that 2024 will be an interesting year for politics, certainly. You mentioned some things I want to dive in on, two topics, both Ripple decision and investing. Start with the Ripple decision and then kind of move into how that also impacts investing. When you look at that Ripple decision and you think about how Ripple perhaps was in a bet the company litigation kind of position, how do you think that plays out in the market today? You mentioned one aspect where market participants will be more willing to challenge regulatory decisions, a bit emboldened by success that they've seen. What other implications do you draw from this decision, in particular as an investor?
Yeah. But I think that's an important one, right? That people aren't going to be afraid to fight back. I think that, and I don't really have a strong perspective on how the SEC will respond. I mean, I think that, you have to assume that they're going to challenge this. And I think that one thing that's important to sort of unpack is the different layers that exist within a regulatory agency. You've got career staff, which are people that are motivated by public service, like smart people, dedicated people, really, I think mostly nonpartisan people, right? Who just want to sort of see their kind of produce good outcomes for consumers. And then you've got sort of the political side of it. And regulators, I think historically were less political than they are now today. But they've become more political. Let's be honest about it, right? I mean, starting with the firing of the CFPB director, the ousting of an SEC head, and they have become sort of more political. And so in terms of how the SEC responds, I'm not totally sure. I think that typically regulators want to win. And so they only take cases when they think they can win. But now it seems like it's been more of a sort of a roll the dice sort of strategy. But I mention all that because I think that people will be watching. We're entering, as we talked about, in an election year. If you look at sort of the average tenure of an SEC chair, most chairs don't stay the full 5 years, right? I mean, they stay something more in the 2.5, 3.5, maybe 4 year range. And so I think there'll be a lot of people looking to see what kind of when leadership change happens and what that could do. But I think in the short run, I think the Ripple decision has totally changed the narrative. I think that it has given a lot of people just sort of, I think you'll probably see people pushing the boundaries, right? Which is sort of the unfortunate thing when you see sort of courts making policy. But I do think you'll probably see more activities sort of in the token space and the token issuance space.
Will we see the rebirth of the alt token season?
Yeah. I think people are still being pretty cautious at the moment, but I do think that there's again like more of a focus on fundamentals now, right? Like the founders I see are keenly sensitive to regulation. Actually, they want to build in a way that and I think rightfully so. I only see. I'm sure there are some outliers, and the founders I tend to talk to, there's some like bias, right? Because the ones who want to talk to me are the ones who care about these issues. But I think
bias.
Right. When it comes to tokens, I think that what I'm saying is that the people who want to launch tokens are really only where the token actually makes sense for the business model. And it's not just a token for the sake of a token. So I think we probably will see a rebirth kind of in alt tokens, but probably more grounded in reality.
So before we dive into the investing side of it, why don't you kind of talk to us and tell us where you are as an investor? Like, what are you doing right now that has you talking with these founders, and then dive into what you're looking for?
Yeah, sure. So I launched a new venture capital firm earlier this year called the Department of XYZ. And as the kind of name might suggest, like our focus is being a bridge between founders and government. Very culturally two very distinct and different groups and sets of culture. And we want to sort of bridge that world and help innovators, founders navigate it and build in a responsible and compliant manner. And we are, some of the themes that I'm interested in now is, stable coins. I really think stable coins, as I believe the stable coins will be the payment systems of the future. And I think it's going to be just an enormous space, particularly as it relates to anything cross-border. And it's going to be a more, I think, complicated is the wrong word. I think it's going to be a more extensive ecosystem than maybe I would have thought a few years ago, where I think you're going to have all sorts of players in the space, including local players in different jurisdictions throughout the world. Tokenization of real world assets is something that people have been wanting to see for a very long time. You see, as Lumida is very well aware, you've seen almost every large investment bank put out some eye-popping projection, right? Ranging from 5 trillion to I think it's trillion, right? Am I getting it wrong? 5 billion? I think it's 5 to 15 between now and 2030, right? In the amount of tokenized real world assets, which is, kind of hard even for me to believe. But I absolutely think that's a major trend. The other thing I think that sort of we're starting to see, and I think it's a narrative that hasn't really been talked about as much. I think when some people think about blockchain, they kind of get too analytical, and they think about efficiency or speed or cost reduction. And I think that actually, some of those, that can be a benefit for sure. But I think one of the biggest benefits that is sort of under discussed is blockchain as a means of equalization in society. And you're seeing that today between wealthy countries and less wealthy countries. It's probably where you see the most significant use cases. So that's in the form of, for example, stable coins and people who live in Argentina or Lebanon or Turkey or other parts of the world being able to hold US dollars in a high inflationary context. That's what's motivating, I think, a lot of what you see in the tokenization of T-bills, which is another big trend. And I think people sort of see as almost like an interest-bearing stable coin. And those products are almost exclusively only available to non-US persons, actually the people that are involved in these tokenization projects. So again, it's like this equalization, leveling of the playing field type of opportunity. And then of course, in the credit space as well, like taking credit from places where it is, or capital from places where it is abundant and making it available in places where it is more scarce. So I think that's another theme that, especially kind of in the interest rate environment we're in today, will be a dominant one for the next several years.
Yeah, very interesting point on inflation. We think we've been experiencing headline inflation in the United States that is challenging. And when you talk about countries like Venezuela and Lebanon and Argentina, we don't understand inflation until we live in an environment like that, which is why there's the flight to a U.S. stable coin for places like that, where you just can't trust that your money in the bank in your local currency will be able to get you anything. Right. So a really, really challenging environment. So Department of XYZ, you're looking at early stage venture investing in the digital asset space. When you look in that space, you talked about some themes, right? Some real world tokenization and others. But what do you look for in terms of an investment opportunity? Like, what are the key heuristics you think about when you look for an investment?
Yeah. I mean, I'm focused early stage, so pre-seed and seed. And so there it's, I mean, largely founder, right? Founder quality. And you're looking for founders who ideally have built businesses before or have worked in the space and have domain expertise. I think you're also, though, for this space, you're looking, and for me in particular, kind of with my fund thesis, you're looking for founders that have just kind of a strong moral compass. I mean, maybe that's like a little bit of an overstatement, but just like that are very sort of ethical people.
You too have been affected by the CM Bankman for you.
Yeah, right. Yeah, maybe. Yeah, right. Exactly. Right. But I think it's that, and then they're just operating in a huge. They're building in an area that's just with a huge TAM and like a huge sort of opportunity set, right? I think those two things are sort of the most important ingredients for success at an early stage. And again, I think you're seeing a lot of that. It's interesting though. You're seeing, and I think crypto is the area, or digital assets, where it may be the first area that existed like in the history of the world is like this, where, you know, a lot of these teams are global from day one, actually. I mean, it's not like fintech product where it's like you start in one state and then you sort of grow and then you expand to another country. With a lot of companies in the digital asset space, I mean, they are geographically dispersed from day one. And that's another thing, that's been another important theme for me recently, is jurisdictional optionality, right? That if you're too heavily focused or weighted in one jurisdiction, it's just too much risk today, right? You've got to be in multiple jurisdictions from day one largely for regulatory reasons. And I think that is going to, I think there'll be probably some interesting implications of that we haven't really thought through. Like, what does an industry look like that is like from day one?
Yeah, that's really interesting. Almost brings us full circle back to the regulatory environment of whether it's the US or international jurisdictions. Maybe take us through as a final thought relative to investing, what you think that looks like in the future if global actors now not just need to navigate a dual banking system in the United States with 49 potential money transmitter regulators and a federal government that may be regulating through different agencies, whether those are banking agencies or the Securities Exchange Commission, let alone maybe the CFTC. And now we're talking about some of these international jurisdictions as well. How does one harmonize a business and their approach through that complexity? Can it be done?
Yeah, I mean, I don't think we know yet, right? And then, I mean, to be fair, I mean, like, this is mostly, I mean, this is on the more decentralized end of the spectrum, right? As I think probably kind of everyone listening now is like, I mean, it really is sort of a spectrum that exists in the decentralization space, and you're seeing that kind of approach really be possible more on that kind of fully decentralized side. But yeah, look, I think what does it mean in practice? I think it probably means it's just like when you pull together different like skills on a team or whatever, like math, just different things emerge than you would have expected otherwise. And I think that's probably what will happen here. I think like you're probably going to see sort of unexpected opportunities, unexpected markets, right? I mean, I just think, for example, about stable coins as a payment system and enabling much easier sort of cross-border. I mean, I could purchase something directly from an artisan or whatever in Latin America as easily as someone in the Catskills of New York. And so I think that it, again, is sort of relates to that equalization trend I was talking about. And we probably, and I think that's sort of in line with how you would think that capitalism would sort of evolve, right? Sort of ever seeking to kind of reduce rents in the system. I mean, if it's working effectively, and make it more efficient. And yeah, I think that's what we're seeing. I mean, big picture wise, like I think tokenization is a huge theme, because I think if you think about the history of money, it is sort of evolved in a pretty consistent direction over the several thousand years it's been around. It's evolved in the direction of greater efficiency, greater speed, greater ubiquity. And I think that the next phase is that value is sort of, I mean, people talk about it in terms of like the internet of value. I think another way of thinking of it is like an invisible oxygen, right? That sort of everything that is sort of, and it's a little scary to think about in some ways, right? But it's sort of everything, every form of value that can be tokenized will be tokenized. And I think that it will sort of work behind the scenes to enable our modern lives to function. That said, it's like hard to totally understand all the implications of that, but I definitely think that's where we're headed.
Very interesting. Great place to conclude the conversation, leaving us thinking about what does that mean for the future, and perhaps does everything become the value of compute, which be a fascinating world to be living in, and wonderful to think about the ability for equalization across markets. Although there's still some structural challenges that may exist. If the paint costs more in the Catskills than it costs American artists, and how kind of like one unit of value differentiates between the two. But I think it's going to be wonderful to be a part of the space and see how these things evolve. We're certainly at a very unique time in the history of money as a means of exchanging value in a decentralized and global economy. So, Matt, thank you so much for the time today. It was really wonderful to talk to you. Shared some really, really insightful thoughts, particularly around domestic and international regulation, and then how that relates to kind of like early stage investment and some of the themes that you're looking at. Thank you so much.